Welcome to the InterMarket Analysis video update. This is a weekly video that I do where I look over not only the stock market, but other markets to see how they're interacting with the stock market in general and the S&P 500 in particular. This is being prepared for Monday, January 30th. I have a few new charts and some updates to tell you about, so please feel free to watch the entire video. First thing that we look at is S&P 500 valuation. This looks at the trailing 12 months going backwards to see on a historical basis, is the stock market considered to be expensive, fairly priced, or inexpensive? Sometimes we use the word cheap. The red line here marks a PE ratio, a price earnings ratio of 20. When we get above that 20 level, the market is considered to be overvalued. When we're at this blue line, that's a PE ratio of 15. The market is considered to be fairly priced. When we drop down to the green line, that's a PE ratio of 10, and when we're at that level, the market is said to be undervalued or cheap. Right now, we continue to be overvalued on a trailing 12 months basis. The market uses forward-looking PE ratios, but this can give us some good insight as to the overall state of the market, and we can also see through time how the market has acted. Down below is just the spread between the current value of the S&P and the red dashed line up above. Here's another chart which has some major events that have happened. You can see way over on the right, that's where we are at right now. The first thing we look at is growth versus value. When growth is in favor, the stock market really tends to go up. You have a lot of growth stocks. You want to buy at 10, sell at 15 or 20 or 30. The other side of that tends to be value stocks. These are stocks that people get into because they've stood the test of time. They tend to be more seasoned companies, and they're considered to be not really growth oriented, but more value oriented. We can look at the growth index and see that it's in an overall downtrend. It has been improving lately. And with the bouncing around that we've been doing, we might get ready for a golden cross if we can break above both of these lines. This red line is the 200-day moving average, and the blue line is the 50-period moving average. When that crosses above, that will turn things more positive. On the other hand, we have value, which did give us a recent golden cross, and it is still in an uptrend overall and is performing quite well currently. And you'll see that as I go through the video. This compares growth stocks, where they've been underperforming, against value stocks, where on the bottom you see the value stocks have been outperforming growth. And so that has been the place to be since the beginning of 2022. We can look at a number of different ratios. This is a ratio of a growth index versus a value index, where growth had been doing quite well through 2020 and even into 2021. In 2021, we had some problems here, but we were able to bounce back. But then in 2022, we've been in a downtrend where growth is underperforming, or we could say value is outperforming. And that's what we see in the next chart. Value in relation to growth has really been doing much better. We can also look at some ETFs. This is the SPY, which is the ETF for the S&P 500. And in 2022, we went into a downtrend and we continue to underperform, although recently we've seen a bounce back. Here is value, which really was underperforming, but in 2022 has been outperforming. And even though it did decline, it's still in an overall uptrend. Here's another index looking at growth versus value, just showing again how growth has been underperforming value. Looking at some other markets, these are the 30 biggest U.S. software companies. They're showing some improvement here, but we're still in an overall downtrend. The CRB index is on top. This is a monthly chart showing how we've been in an overall uptrend, and that's been fueling a lot of the inflation that we've been seeing. Down below, we take a ratio of inflation areas versus deflation areas, and we're still underneath this moving average, but we're starting to come back up, and that could suggest that some inflationary pressures are starting to come into the market. Here's the Baltic Dry Index. This is another tool that we use to look at overall inflation. This is in an overall downtrend. What this index does is it says how much does it cost to ship things from one place to another. If the cost is going up, that produces more inflation. If the cost is going down, that produces deflation or non-inflation. Another thing we look at is the CRB index, where it's been in an overall uptrend starting in late 2020 through 2021 and into 2022, but recently has been seeing some weakness and is now in an overall downtrend, even though it's technically moving more sideways. Corn, after spiking up and coming down, has been climbing back up slightly. Aluminum really spiked up, came back down, and has been going back up, but we're still in an overall downtrend. Heating oil, after getting really high, has been falling back down. Gas, this is what we feel the most. We really spiked up, came down, hit a low here, but then we've been going back up. Natural gas really spiked up at 10 and then came all the way down and is now below 3. Oil, after going up to 130, has come back down, hit 70, went back up above 80, but then closed just below 80. Here's the retail diesel price index that I look at. This just shows what is the price for diesel, and trains and trucking use a lot of diesel. And even though we've been coming down lately, it's still pretty high compared to what it had been. Wheat, it spiked up, came down, bounced back up, and is now continuing to decline. Fertilizer, which is used for a lot of agricultural products, it has been coming down after really spiking up. Lumber, another thing we use to build things, it's been in an overall decline throughout 2022, but now is starting to bounce back up. The dollar, which was really strong in 2022, has now gone in a downtrend. We see a death cross here. The dollar's been really declining. And the euro has been advancing, where the dollar has been declining. Then we have the Japanese yen on top, which had really been falling, is now going back up. The euro, which also fell, going back up. And then the dollar, which was going up, is now starting to go down. The British pound just saw a recent golden cross, and it's been going up when you compare it to the dollar. The Japanese yen also had a recent golden cross and is now in an uptrend against the dollar. Copper, which, as I say in every video, we call it Dr. Copper. When copper is going up, that tends to mean a better economic climate. When it's going down, that means we're having a difficult economic climate in the future. Well, now it's been starting to come back up, and we actually saw a recent golden cross. Copper to gold shows that copper has been really outperforming gold overall. The copper to gold ratio shows how copper has been outperforming gold. We compare that to a 2-year treasury yield, and this spread is really far apart right now. They have a tendency to go in the same direction, and they tend to not get very far apart from each other. Even though they're on different scales, they're quite a ways apart from each other now and not really going in the same direction. Gold gave us a recent golden cross and is now in an overall uptrend. Silver also in an overall uptrend. Looking at some indexes, the CRB index, which measures all the commodities and inflation, that had really been going up, but is now starting to underperform the S&P 500, where it shows here the S&P 500 had been underperforming and is now starting to outperform. The NASDAQ 100 is still in an overall downtrend when you compare it to the S&P 500, but we're seeing a really nice bounce currently. The NASDAQ 100 and the NASDAQ have done really well over the past couple of weeks. Some other areas that we look at, mega cap growth, these are the really big companies. They have been in an overall downtrend, starting to bounce back up, but have not switched to an uptrend yet. Here's a new chart. We have the S&P on the top, and then this is mega cap growth, the chart that I just showed you, on a ratio with the S&P 500, but not the regular S&P 500. This is the S&P 500 equal weight, where the S&P 500 is a weighted index, so the bigger the stock is, the more influence it has on the value of the S&P 500. Well, the equal weight index is exactly what its name says. All stocks inside the S&P are given the same amount of weight. And sometimes we can look at that and get some insight. Haven't been able to do that too much in 2022. This is one of the first charts I'm showing with the equal weight index. When we compare mega cap growth, it's really been underperforming the rest of the S&P equal weight, but it is starting to come back up, but it's got a long ways to go before we see a golden cross. Here's another new chart where we have the S&P on top. Usually what I show in the daily videos is the bullish percent index for the S&P 500. That just measures what's going on inside the S&P 500 itself. Another thing that gives us a little broader measure is the NYSE bullish percent index. It's a much broader index, so we can get a pretty good look at that. Well, it's been doing well. It's above 50 and advancing, so that's positive. We're not up to the 70 level yet, which is when we start to get extreme positive, but we're coming right back to the highs set in August. And is this going to act as some kind of resistance, or are we going to be able to break through that? The S&P 100 continues to underperform the S&P 500, but it is trying to make a comeback. These are the biggest stocks in the S&P 500. Small caps to the S&P 500. In a good, healthy environment, we want to see small caps going up. They are in an uptrend, but when you compare all of this together, we've been chopping sideways more or less. We want to see this really turn and go up, and that sometimes will give some support to the S&P 500 going higher. Low volatility ETF, this is what folks like to get into when the market's running into trouble. You can see for 2022, even though it declined some, and it even was in a downtrend for a while, it held up a lot better than a lot of the growth areas of the market. We're just seeing a recent golden cross here, and it's starting to resume an uptrend, even though it's been chopping largely sideways. Here's a comparison of the S&P 500 to the low volatility ETF, where the low volatility stocks have really been outperforming, but are seeing some recent weakness. The Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and combines them into one average, saw a recent golden cross right at the end of 2022, and we're starting to go up. Looking at some Dow theory charts, we're kind of seeing a little divergence here, where transports were kind of breaking out, but the Dow was not. Right now, the Dow's really been doing quite well lately, even though a few of its companies came out with earnings that weren't well received. It had been really outperforming, but over the last few weeks, it's been underperforming. And then down below, I also include utilities. Most people just look at the Dow and the transports as part of Dow theory. I like to include this third area as well. I just look at this chart. I don't have any studies on here. I'm looking for some kind of divergences as we go along, either positive or negative. The FANG stocks really starting to go up, but are still in an overall downtrend. And kind of the same thing with ARK. It got down to a little bit below 30 and is now bounced up, and it's currently a little over 40. Here's a new chart. We're starting to hear some more buzz that international stocks outside of the U.S., are getting a lot more favor, and that could be happening. When we compare the S&P 500 to the Dow Jones Large Cap Global Index, we've been in an overall uptrend. But if you see way up here on the right, it's starting to come down, and it's getting really close to this 24-period moving average. The chart that you see here is a monthly chart. It's much longer than the daily and weekly charts that I usually show, and it goes all the way back to 1992 to give you some kind of an idea of where we're at. Down below is a thing called the KST. It's the no sure thing developed by Martin Pring. One warning sign that we see here is that the KST is starting to roll over. If we break down below this support right here and the KST starts going lower, that could not bode well for S&P 500 stocks. If we do see this start to go down, that means that global stocks are outperforming U.S. stocks, which is the S&P 500. Here's another look at the S&P 500 against another European ETF, also coming down to what could be pretty critical support. However, if you look at the bottom, we have the PPO, which is an oscillator that we use. It's dropping below zero. If it can turn back up, like it did back in 2017, and then we really saw it dip down in 2009. Once this turns up, if we do get to that point, it should help the market turn more positive. Looking at bonds, we're seeing a lot of improvement in the bond market, where here's a bond ETF starting to come up. It hasn't quite gone up enough yet to see a golden cross, but we are getting close. And here's a world bond index, also not at a golden cross yet, but seeing some real improvement after bonds really had a difficult year. Here's a monthly chart of the stock to bond ratio. Stocks are still outperforming, but we're seeing them pull back just slightly. Here's bonds to stocks based on the shorter maturities. We're seeing that bonds are not really outperforming. Here's another chart that's new. This is high yield corporate bonds. We don't just look at government bonds. We want to keep an eye on corporate bonds. We just saw a recent golden cross, and this is starting to go up. So as bond prices go up, that brings interest rates down. Here's another one called Investment Grade Corporate Bond ETF. It's also giving us a recent golden cross. When we compare the stock to bond correlation, it shows that they're going in opposite directions now. If bonds are going up, stocks are going down, and vice versa, and they have a pretty strong inverse correlation. We're also noticing a large part of the yield curve is inverted. I don't plot all of the different maturities that you can, but we have the 10 to the 2, which is inverted, way over on the right-hand side. The 10 to the 3 month, this was the last one to go inverted, and now it's becoming the most inverted. It's going down, down, down. The 30 to the 5 year is not inverted right now, but it spent a large part of 2022 being inverted, and the 10 to the 5 year is still inverted. The one on the bottom would be nice, but it only updates about once a month, so it doesn't really help us all that much. Here's the Dow Jones Corporate Bond Index, where we're just seeing a golden cross. That could bode well for government bonds. Here's the 10-year Treasury yield after really spiking up, has then been coming down. Here's another look at that same yield. We're currently at 3.518%, much higher than it was, but also much lower than it had been not so long ago. Here's the 30-year bond after spiking up, has been coming back down. It's at 3.64%. Here's the S&P 500 to the 10-year Treasury yield, where the S&P has really been underperforming the rise in interest rates, and it continues to do so. The junk bond fund, these are high-grade bonds where you have more risk. That's why they call them junk bonds, but you also get a higher yield. And when this is going up, that can give some support to the stock market. We're just seeing a recent golden cross. Another thing that we can look at is the junk bond ratio to the bond ratio, where junk bonds have really been outperforming government bonds, and they are continuing to do so. Even though government bonds have been doing better lately, the junk bonds are still in an uptrend when compared to the government bonds. Here's a daily chart of the yields, showing how, for the most part, we've been coming down with our yields, although the 3 month is just continuing to go to the moon. This is why we have so many inverted yield curves. The 3 month is giving a lot higher yield right now than the 2 year, the 5 year, and the 10 year, and even the 30 year. And this is all kind of a mess, and it's been a mess for quite a while. Here's a weekly chart of the US, UK, Japan, and German rates. The US, the UK, and Germany have been going up, and now we're starting to come back down. And Japan's kind of in its own little story, and I kind of add tidbits to that story throughout my videos. Looking at the S&P compared to other sectors, we really watch this closely. When the S&P is outperforming utilities, that often gives some real decent support to the S&P. When it stops going up and this ratio starts coming down, that quite often marks a top in the market. Right now we've been chopping around, but we're still kind of going up as of late, and this could be helping the S&P to go higher. Here's staples. These are the things that you have to have no matter what's going on in the economy, just giving us a recent golden cross. Even though once we had that cross, we've been seeing some weakness, so this may not last very long unless staples prices can really pick up. Energy to the S&P 500 sector shows how energy has just been the place to be since the beginning of 2022, and it continues to be in a solid uptrend, especially when you compare it to the S&P 500. The tech sector doing a lot better than it had been. We're still in a downtrend overall. If we continue to see some more strength going into tech, we might get a golden cross very soon. We did get a golden cross. We're in the process of getting one now with the semiconductors, and this is a huge part of tech. And if this can continue to go up, this will help the semiconductors, obviously, but it will also really give some support to the technology sector. Here's the tech sector against the S&P, which just shows 2022 was not a good year. We're starting to show some bit of a bounce here, but we're still in an overall downtrend. Some other areas to look at: growth, which really suffered as of late, and bonds, which suffered in 2022. So we pretty much have been chopping sideways. We're getting ready to see a death cross here, where growth is really starting to underperform bonds yet again. And the 10-year Treasury yield has really been rising when you compare it to the tech sector, even though it has been coming down of late. And then here's just the inverse of that same chart, showing how the tech sector has really been underperforming the rise in interest rates. Here's discretionary, the things that make life fun, and their ratio with how they're performing against staples. We're seeing a really nice bounce here, but it's not enough yet to give us a golden cross. This is an inverse of that same chart where staples have been really outperforming. Now they're starting to show some weakness, coming down and testing this 200-day moving average. And the energy sector has been really outperforming the tech sector, where if you drop back to 2018, 2019, the tech sector had been really outperforming the energy sector. Gold to the S&P 500 is still in an overall uptrend as gold is starting to show a little bit of strength right now and still outperforming the S&P. And gold to the US dollar, as the dollar has been declining, the gold ratio has been going up, so it's starting to outperform. High leverage loans, these are very risky loans. And if we were really headed for a cliff, economically speaking, we would not really see this continue to go up. But we just saw a recent golden cross, and it's starting to advance to higher levels. Here's the InterMarket Analysis chart going back to the beginning of 2022, just to give you some historical perspective. Oil has been performing quite well, followed by the dollar. Gold lately finally went positive, and it's starting to do a little bit better. Stocks and bonds, even though they're improving, they're still down if you go back to the beginning of 2022. Looking at some index comparisons, here's the American Stock Exchange, the NASDAQ, and the NYSE. We take a 5-period moving average of the highs minus the lows. When we're above this zero line, that is more positive. We use this as one of our possible positive setups. When we get a real extreme negative reading and then jump up out of that, that can often give some support to the market. But it was quite a while ago that we had this drastically negative reading. Small cap index given a recent golden cross and showing some nice advances. Same thing with mid caps. And the Dow is also in a pretty significant uptrend, but it's not really breaking out yet when you compare it to where we were at just last December. When you look at the Diamonds ETF, which is the ETF on the Dow, it's in an overall uptrend with green bars. The NASDAQ, even though it broke through its 200-day moving average, in one of my daily videos, I thought that we might hit this level that could act as overhead resistance because we hadn't hit the 200-day moving average since 2021, but it was able to plow right through that. Doesn't mean that we're going to just keep going up. It's looking better now, but if we see some weakness, it could come back down very easily. And then the same thing can be said for the NASDAQ 100. It just broke through its 200-day moving average. It looks pretty good right now, but if we see some weakness, it could come down quickly. And then looking at the Elder Impulse System for the triple Qs, which is the ETF for the NASDAQ 100, they're resuming their overall uptrend. NYSE Composite, giving us a recent golden cross and is starting to get more into an uptrend. The Wilshire, though, hasn't crossed yet. And this is also another broad-based measure. All stocks, which takes international stocks as well as U.S. stocks together, we're starting to see a golden cross here and prices continue to advance. Emerging markets also seeing some real strength as of late, enough to give us a golden cross. Looking internationally, all of these stocks, China, emerging markets, Europe, Japan, and the U.S., according to the KST, are in uptrends. Bitcoin is still in an overall downtrend, but it's starting to see a little bit of improvement. It had been down in the 17,000 range and has now been able to get back up to 23. It's coming back up to the 200-day moving average. Looking at some correlations, the S&P 500 to the dollar having a slight tendency to go in opposite directions after giving us a recent neutral reading. S&P 500 to oil, right neutral. We're just at the zero line, so they're not really exhibiting any noticeable relationship. The S&P 500 and the 10-year yield are having a pretty strong tendency to go in the same direction. So if yields are going up, the S&P is going up also. And the tech sector, the 10-year yield, also having a pretty strong relationship now. And the S&P 500 to the 2-year also. So what we're seeing in the last three charts, interest rates are going up and stocks are going up as well. That's usually not how it works. When interest rates go down, that usually gives some support for stocks to go up. The fact that this is happening could produce some kind of an imbalance because it doesn't stay that way for very long. If we see that relationships start to shift a little bit, that could either help interest rates to go down or help the S&P 500 to go down. And then another thing that I'm keeping a close eye on is the home builders ETF. Sometimes this can give us some insight. When the home builders ETF is going up and the S&P is going up, that's usually much more healthy. And these aren't trend lines of any kind. This is just to accent what's been happening on the price chart. We've been seeing a nice run up with the S&P. We're seeing kind of a breakout a little bit with the home builders. The ratio is showing a little bit of a negative divergence. It's not really breaking out the way we would like to see that. And as the home builders have not been keeping pace with the S&P 500, we're seeing this relationship start to weaken down in the very bottom area. We look at this because there are times when the S&P was going up and home builders might be going up. That's good, even though we ran out of gas pretty quick. But then there's other times, if you look back here, where the S&P was going up and home builders were going down. Those are the things that we're trying to look for. Some kind of negative divergences here. All right, I reworked the list again. So the things that are positive are the value indexes and ETFs, the euro, the Japanese yen, and the British pound when you compare it to the dollar. Gold and silver are positive. The low volatility ETF is positive. The Dow Jones Composite Average. Bonds, the ETF for all bonds. The high yield and the investment grade bonds and corporate bonds have also switched over to positive. Junk bonds are positive. Staples are still positive. Semiconductors, high leverage loans, small caps, mid caps, the Dow, NYSE Composite, all stocks, and emerging markets. So our list is starting to get a little longer as we continue into 2023. We had only 2 or 3 things on this list for a long time. All right, the negative side. Growth is still negative. Dynamic Software Intellidex Index, that's those big software companies. That's still negative. The CRB Index, the US dollar, mega caps, FANG, ARC, world bonds, they're getting close, but they haven't had a golden cross yet. The tech sector, getting close. The NASDAQ and NASDAQ 100, Wilshire, and Bitcoin continues to be negative. Thank you. I hope you found this valuable. Please feel free to check out the daily video that is posted now, as well as the weekly video. I'll also be preparing what I call the deep dive video, where I go through the charts that I don't always show in the videos, just to give us a chance to see some things, because it's still a good idea to look at those. Have a great week, and I will talk to you in the next video.